So today we're going to see if Alibaba stock is a buy, and we'll look at some of the positives, some of the negatives, and then we'll see what potentially the share price could be worth in the next 5 years. And that's following on from the PayPal video that we did the other day. That was very well received. There was a mix of opinions. Some people like PayPal, some people do not like PayPal, but it was well received. And like I said, sometimes putting these videos together, this sort of format of video does take a while to put together. So I don't mind doing it, but if I am going to do it, I do like it where the like button's smashed and the views are good. And with the PayPal video, that happened, so I thought, you know what, let's make another video on a stock that is a little bit more 50-50. Some people love it, some people hate it, and that's Alibaba. So let's do a bit of an update and see what is going on with Alibaba right now. Let's get started. And as always, if you do want to see more content from me and support the channel, the place to be is on the Patreon. It's only £5 a month, and you get 2 exclusive videos a week on there. I will drop the UK portfolio very soon for you guys that are on the Patreon. But let's take a look at Alibaba. Now, for full disclosure, I do own shares in Alibaba. I've owned shares in Alibaba since about 2018, when the China trade war was going on, when Donald Trump was the president, and during this period of time is when I did start picking up some shares in Alibaba. Since that time frame, the stock did rally up into 2020. I did sell off half my position in Alibaba for about 100% return during that time frame, and then the stock started going downwards, and I've been a buyer of Alibaba since. So obviously take that into context when I do start speaking about Alibaba. But obviously at the moment it has had a very tough time, really, since it had a bit of a boom during the CV times. Obviously even in China, the online sales went absolutely crazy, but since then there's been a few things that have affected the company, and the shares have gone very low down. And as you can see here, it's around about $91, and that does mean shares are now below, or roughly they are below when it IPO'd in 2014, and it's very close to being near the all-time lows during 2016. So yeah, it's very had a big drop on the share price when you look at that point of view. It does trade around 20 times earnings, so we do have a P ratio, and we do know the company is profitable, but it is off its 52-week lows, which were around about $58. Now, this does trade on the New York Stock Exchange, and it is an ADR. So if you haven't looked into what an ADR actually is, that's obviously worth pointing out as well. I know a few people get furious when I don't mention it's an ADR, even though it's in the title. So for you guys that get a little bit sensitive over not mentioning that, there you go, right there. Now, obviously, share price. Let's talk about what's kind of going on here. Why is the share price absolutely being devastated? Why the stock is down nearly 70%? Well, the first thing is the Chinese economy. The Chinese economy and the China trade war and the US and China trade war has been going on since around 2018, since 2019, since Trump came in, and has kind of continued since then. There's been a lot of tariffs between the US and China, and obviously that's hurt the Chinese economy. Combine that with the fact that China has basically been in a lockdown for 2 years. So whereas basically a lot of the more Western world, when the CV situation happened in 2020, we kind of locked down for the first year-ish, and then after the first year, we kind of went, I think we're just going to have to live with this, and the economy kind of opened back up. China, nothing like that. They had a zero policy, or a zero COVID policy, where basically if there was any kind of 10 cases in a city, boom, shut down. And there was no mass adoption to a vaccine either. So the economy suffered. You had the kind of impacts from the China trade war. Add on top that basically every time there was any kind of cases, the economy shut down. That affected the economy. And also the fact that China actually, or the Chinese government, actually started turning on its own companies and cracking down and making it hard for the tech giants like Tencent, like Alibaba, making it hard for them to do acquisitions and affecting other parts of the business as well. One of the big ones was the Ant Group of Alibaba's fintech arm that also had a big issue as well with the regulators of the Chinese government. So there's a lot of things that have gone on. A lot of this you can find on the internet. I thought I'd just mention it as a whole, what kind of went on there. Now, from around about the back end of 2022, the shares are up a little bit at the moment, and the reason why is because some of those issues are starting to get resolved now, and one of them would be the China crackdown on Chinese companies. It seems like they are now starting to be a little bit more supportive of these Chinese companies like Alibaba and Tencent. Obviously, one of the reasons why is because they've seen how much they've struggled on the share price. They've seen how their impacts of their new regulations have affected the Chinese economy. they're looking at the Chinese economy and going, we've been that harsh on our companies, our economy is now being affected, our companies are now being affected. And obviously for them, obviously that they increase taxes, the money they make, the money they can go spend on things. So obviously they've kind of realised the impacts that they're having on the businesses, and they've kind of been a little bit taking the foot off the pedal a little bit with regulations, and that's obviously helped the companies do a little bit better now financially, and obviously on the share price, investors are a little bit more willing to buy back into the stocks. Alibaba itself has made changes. It's decided to split the company up into 6 units. I think this obviously from a regulatory point of view, where the Chinese government don't feel like Alibaba have a monopoly, so they didn't put as many regulations on top of them, but also the ability to kind of manage them all independently, give them their own budget, give them their own kind of CEO, and kind of make sure they can flourish and not under the pressure, or one of them goes missing a little bit with another area getting a little bit too much focus. Maybe the cloud gets a little bit too much focus, and then another area doesn't get the focus inside the company. So they're going to split off the Tabayo Tmall part of the company, as you can see here. The Global Digital Commerce Group is going to get split up. The Cloud Intelligence Group, obviously that's a key drive that a lot of people will look at. Local Services Group, the logistic business is going to get split up, and also the Digital Media and Entertainment Group as well. So this is really good because you could potentially unlock more value individually, and also from a regulatory point of view, it looks a bit better for Alibaba. So this is a really good move that I think a few people are liking that Alibaba are doing at the moment. Also, China itself has kind of got rid of its zero COVID policy, so obviously the economy now is allowed to open up. Every time the economy opens up and there's 10 cases, it doesn't shut back down again. So you can see why there's a combination of factors why people are a little bit more happy to buy Alibaba. And obviously, China at some point realized our growth has massively slowed down. Obviously still growing at the moment at plus 5%, which is obviously a lot of economies would love to do that, but has slowed down rapidly, and they realize they need to get that growth going again. Now, because of those factors that we talked about, the Alibaba is splitting the business up a little bit more, allowing every part of the company to have its own focus, the zero COVID policy being removed, China itself not cracking down on the companies as much. This has meant that Alibaba now can go back to better amounts of growth. So whereas it's been struggling to grow and it's only been growing 1 or 2%, in the latest quarter we actually saw Alibaba come out with good growth of 14% year over year. And as you can see here, the current year expectations is really, we'll call it 8.9, let's call it 9%. And next year 9.7%, moving back towards double digits. So you can see here the growth is going to start coming back hopefully in Alibaba now. And obviously in the latest quarter that looked pretty good as well when you looked at the latest quarter. And also from an EPS point of view, Alibaba was making a lot of really good reorganizations in the company. Cost cutting as well. We've seen the amount of employees start coming down rapidly. So Alibaba's gone back to focusing more on profitability and cutting costs, and as well as that, the economy's opening back up and regulations calmed down, which has led them to obviously have more growth as well. And when you actually go through the recent quarter in Alibaba, you can see the growth really starting to kick back into the company. There's a lot of parts of the company that were starting to grow at really good rates and starting to grow a lot stronger than what they have been doing recently. And when you do look at Alibaba as a whole and all the companies they do own, you do realise that if you are living in China, you are going to be using definitely one part of the business in your daily life, whether it be the financial part of the business, the logistics, social media part, the messaging part of it, Alibaba Health. You can see why under one umbrella now it is quite tricky to manage this, so it does seem like to unlock all the individual value, that would be a very good move from Alibaba. And I think sometimes people don't realize the amount of companies that Alibaba do own and what you are getting with Alibaba as well. So obviously that is quite positive how I spoke about the company here, but obviously what are the kind of negatives with Alibaba? Well, it's ultimately what caused the original share price drop is regulation. We've already seen them kind of saying that the first kind of country to kind of regulate AI services, and I think there will be more and more. The biggest threat without doubt is more political risks and regulation risks from China, and that's ultimately where I think a few people have struggled to buy it, because they are unsure what the next move is going to be from China. And very quickly, they could say one thing and snap the fingers and go in the other direction, and that's what ultimately did affect Alibaba at the moment. And we've seen it with other companies. I own another company here that's been affected massively by regulation. If unfortunately China's government basically says, right, you're doing it this way, unfortunately, a lot of these Chinese companies have to follow it, and it hurts them. So without doubt, some people will point to an ADR risk. I don't think it's that much of a high risk. I think your big thing is your Chinese government and regulation. That is the big thing that is the only negative to here, and that's what does put a few people off buying a stock like Alibaba. But if you think that the Chinese government has got to a point where they go, you know what, we've got to be really careful about how much we do affect these companies, because otherwise, as we see, the Chinese government starts, or the growth of the economy starts going down, then the Chinese government have less taxes coming in. They're able to spend, or they're not able to spend as much money. That means things like, the army, for example, they can't put as much funding into the army. So they kind of really have a balancing act now where they've kind of realised they've maybe gone too far. But a few people might say the risk is that they can always turn around and snap the fingers once again, and it could affect the company. But like I said, obviously the growth is coming back. They've looked like they've realised they've gone too far. If we have a look into the company at the moment, past growth, it has a good track record, as you can see here, of growing revenue and profit. But you can see the slowdown in profitability as the regulation and the CV situation did start coming into Alibaba. You can see that did have a dip in the profitability, as well as the revenue failed to grow as much as the profitability. And also there's a few expenses inside the business. But going forward, the company is now focused, or should go back to growth. As we saw earlier, we're expecting around 10% revenue growth going forward. Profitability, previously the really tricky thing is that they did have very good profit margins, as you can see here, 40, 50, 50%, 28%, 22%. Unfortunately did dip down into the 3%, but now back up to the 9.4%. So the profitability margins is the really tricky thing, how consistent they can be, but growth has always been consistently quite good. Let's take a look at what potentially Alibaba and the upside could be worth. Now, the key things is to point out that they are currently doing a buyback. The buyback at the moment, as you can see here, the shares outstanding has been going down since around 2021. And at the moment, I believe it's around 50 billion they've currently got. If I actually go on the recent earnings, it actually says how much. So it says that during the recent quarter, they bought 35 million of shares. So if you do have a look into Alibaba at the moment, it's currently $90. I've done two sums once again. As you can see here, the top one is without share buybacks. The bottom one is with share buybacks. Now, at the moment, I have forecast that they're going to buy back 10% of shares in the next coming few years, in the next 5 years. We always do it over 5 years, as I always say. The reason why over 5 years is after 5 years, I think it gets a little bit blurry when it comes to investing. So that's why I always keep to the 5-year range. Doesn't mean that we're going to stop at 5 years, but I think that's the easiest way to kind of forecast and see what's kind of going on and be aware of any competition. Now, obviously with shares outstanding, as you can see here, the shares outstanding did increase by 2%, 4%, 3%. I think they can easily do a 10% buyback, so I think that's a pretty fair number that I've used. And you can see here, the top one is the one without buybacks, the bottom one is with buybacks. So I've done one with a 10% buyback of shares. Now, revenue growth, this is the really tricky thing. So I've done 6, 8 and 10. Now, at the moment, the forecast to grow 10%, and I think they will grow 10%. Historically, Alibaba's normally grown a lot more than that. Potentially, they do get back to higher growth than 10%, especially when cloud comes back a bit stronger, which they have said that their aim is to get cloud a bit stronger. So, even on my high side, you could argue that potentially they grow a bit quicker, but I think 10% is quite fair at the moment. Like I said, profit margin's a little bit harder to predict, because like we said previously, they've gone back to, before, the profit margins used to be a lot higher. The profit margins used to be around 20+%, 30%. So we'll see if they can get back to them levels. Right now they're at 9.4. Analysts are forecasting they'll get back to, I think it's 13 next year. So the profit margins is the really hard trick thing to predict. I put 10, 12 and 14, which is still historically a lot lower than what they've done previously, but is an increase on what they're currently doing now. So I think that's not too bad. What I'm going to do is I'm going to actually change these profit margins in 2 minutes, so you can see it with a bit of a higher profit margin. I actually had a question about this on the PayPal video, and it was something around buying at certain prices, and why was I buying, like for example, why was I buying PayPal at certain prices, even though only now it's showing 100%. It depends on the time of different numbers. Like very quickly within a 12 month period, your numbers can totally change. If all of a sudden we see that, Alibaba goes back to higher than 10% growth, your numbers change dramatically. If profit margin goes up more in the next kind of, if it goes back to the old amounts of profit margin, there's a big difference between how you value a stock if it's doing a 14% profit margin and then it's doing a 25% profit margin. That's the thing with investing, it can change so rapidly so much, and that's the really tricky thing to kind of predict. And despite what everything money might tell you, there's a lot of different factors that can change it. This is why I think that even going more than 5 years is very hard with investing, because very quickly revenue growth can change. Maybe they get a partnership, maybe they'll lose a partnership that generates revenue. Profit margins, very quickly can profit margins get sunk because of competition. Maybe they go up. That's the big variety in investing. That's a little where the risk comes in with investing in general. I've done it at 20 times earnings. Now at the moment, Alibaba does trade at 20 times earnings, so about where it is right now, which I think is fair enough. It's always had a bit of a change of what it is valued at on an earnings basis. Sometimes the earnings are a little bit higher. The thing is, it's always a Chinese stock, so it normally gets valued a lot lower than, say, compared to an Amazon. I always used to go for whatever Amazon is, Alibaba is half the P ratio of Amazon. And also, even though it has good amounts of growth, it always gets lowered. It trades at a lower valuation because of it being a Chinese company. So that's obviously something to kind of price in. So I've gone what it's trading at right now, which is 20 times earnings. And I think that's historically a low P ratio for it. So just take that into context as well. Once again, talked about multiple expansion. If a company's suddenly in favor, it trades at a premium. That's the big thing. Like when you look at something like a Meta, for example, Meta hasn't changed that much in a year, but when you look at Meta's share price, it was valued at $80 and then it's valued at $300. Financially, it hasn't changed that much. It's just all of a sudden the market went, we're going to value at 8 times earnings, and then it valued Meta at 50 times earnings. That's why the share price moved so much. It's same like Alibaba. Alibaba all of a sudden gets valued at 20 times earnings. Financially, the company might not be any different, but all of a sudden it's 40 times earnings because the market goes, we think you should be premium now. That's one thing that also you've got to really consider. Anyway, getting back to this on what the company could be valued at. So on a profit margin of 10, 12, 14%, 20 times earnings. On the low side, if they grow at 6% with a low profit margin, the 5-year upside is 44% and 60% 5-year return, which isn't too bad. And that would be quite conservative numbers, I would say. On the middle side, with a 8% growth, 12% profit margin, you're looking at 86%, or with a buyback, 107%. And on the high side, with 14% profit margin and growing at 10%, you are looking at 134 to 161%. So I think if you can stomach the risk of the Chinese regulation and the crackdown that they always do in China with the government side of it, I think that if you think they can hit these numbers, I think you can see why a few people are interested in it. Now, same again, I'm just going to show you a different variety of numbers. So let's say, for example, they do achieve a little bit higher growth. Let's say they go to 12%. Let's say they get a bit more to the all profit margins. Let's say they get to, we saw they used to do 20+%. Let's just say they do 22% profit margins. You're talking, 195, 340% upside. Let's say that it goes a bit more to the historic multiple. Let's say it goes more towards a 30 times earnings. All of a sudden, you're talking in the next 5 years, you've got nearly 500% upside. If they do a share buyback, you're talking 561% upside. So that's, if you're very, very bullish on this, let's say you think, I think they can get back to higher amounts of growth. Let's say they get to their all profit margins. Let's say they go to more of a premium at 30 times earnings. Then, these are the people that are really bullish on it, are thinking, maybe a lot more upside than that. But obviously, let's be a little bit conservative. Let's stop going for the 3 pointers, and let's make sure that we are not just pricing in the upside, but, a little bit more of a base case scenario. And I think if you're even, conservative on it, I think you fancy, a 100% return in the next 5 years. Obviously, a few more of the ultra bulls will be looking at that going, if they hit the higher numbers, that's where the bigger returns in. But then you'll also have the few people that are worried about the Chinese kind of regulation, the risk of government, and go, what, if they really wanted to, the government comes out in a year's time and puts more of a crackdown into Alibaba, then you might be hitting these lower numbers. But at the end of the day, if the worst case scenario, you could argue that if the worst case scenario did happen and that was the situation, I think if you put 6% growth in, 10% profit margin, you'd be like, it's underperformed what I thought it was going to do. But at least you'd be walking away with, 40 to 60% return on share price. You might be around about where the S&P is in that time frame. But if that's the worst case scenario, I don't think it's too bad. So from my point of view, when I look at Alibaba, to be honest with you, I look at him thinking, there is risk without doubt. You know, unfortunately, as I personally found out as a shareholder of some Chinese stocks, sometimes there is sometimes risks with investing into this sector, but at the same time, as I've also found out, you know, when I sold half my position in Alibaba in 2020, and also some success I've had from buying into the likes of JD.com when they've had issues before, sometimes they are opportunities as well. So it's a bit more down to what your kind of risk tolerance is with this one, and if it's in your comfort zone or not. Anyway, so that's the video on Alibaba, guys. Hope you enjoyed it as always, and if you could hit that like button, that's absolutely amazing. If you're new around here and if you found the video helpful, subscribe, and I'll see you in a bit.